Welcome back to Investing Talk podcast.
Today we're looking at Ethzilla Corp. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We've gathered quite a bit of recent material on Ethzilla. And, well, the first thing anyone needs to know is that this isn't exactly your typical stock analysis.
No, not at all. We're dealing with some pretty extreme information gaps here.
That's putting it mildly. When I look for the standard filings, well, the lack of them, really, some serious warning bells started ringing.
Yeah, if you're used to seeing those traditional metrics for due diligence, you basically have almost nothing concrete to work with here. It's quite startling.
Exactly. The main challenge is just, the severe lack of financial transparency for figures you'd normally expect, like verifiable revenue, gross margin, actual earnings. Our sources just mark them NA, not available.
And the implication of that is huge, right? Especially when you think about regulatory oversight. With publicly traded companies, you expect those mandatory filings. Things like the 10K, the big annual report, or the 10Q quarterly updates filed with the SEC.
And Ethzilla, well, they don't currently file those. So that means there's no primary source data for, say, company guidance or detailed debt metrics or cash flow statements.
So you fundamentally cannot model this company like you would, an Apple or a Microsoft. It's just not possible with the available data.
Precisely. It really forces us into being more of a narrative and sentiment play right now rather than something based on hard numbers.
And yet it's not some tiny, obscure penny stock either. Our sources put the current market cap around, $250.52 million?
Yeah, about $250 million.
So that valuation sitting on top of basically a foundation of NA financial data. That's kind of the core tension here, isn't it?
It absolutely is. And that tension, it just ramps up when you look at how they've maybe sustained that valuation or funded their operations. The dilution figure is arguably the most, shocking data point we found.
Oh, the dilution is just staggering. The company's share count has exploded. We're talking a 337.42% increase year over year.
Wow, 337%.
Yeah. So for anyone maybe not familiar, dilution means they've issued a massive amount of new stock, just flooded the market with new shares, increasing the total number out there.
Think of it like slicing a pizza. If you had one big slice representing your ownership last year, and now they've tripled the number of slices, well, your slice just got a lot smaller.
Right. It's an aggressive way to raise cash or maybe pay for acquisitions, sure, but it definitely can crush the value for existing shareholders.
It really suggests they've had pretty significant, maybe even desperate capital needs that couldn't be met through normal borrowing or profits, since, again, we can't actually confirm they have any profits.
That leads me right to the ownership then. If management is doing things that dilute shareholders so aggressively, you have to ask, whose interests are they really aligned with?
Well, okay, on that front, the insiders do hold a meaningful stake. It's about 15.03%.
15%.
So that's generally seen as a positive signal. Management has skin in the game, Their own wealth is tied to how the stock performs.
Agreed. That's definitely a point in the pro column. But then you contrast that with the institutional ownership, and it tells us a completely different story.
Yeah, it really does. Institutional ownership is practically non-existent. It's sitting at only 0.43%. Tiny.
0.43%. So the big players, the pension funds, mutual funds, those large asset managers, they're staying away.
Almost entirely. And it makes sense, right? They have strict requirements, often mandates for financial disclosure and transparency.
The kind Ethzilla isn't providing.
Exactly. The fact that the quote-unquote smart money is largely avoiding this stock tells you it's viewed as, purely early stage, highly speculative. It just lacks the fundamental data they need to risk large amounts of their clients' capital.
Okay, so let's recap the foundation here. We've got a $250 million company that we can't really analyze fundamentally. Its main way of raising money seems to have involved crushing shareholder value through massive dilution. That's the cautious backdrop.
It is. Definitely the cautious side. But, if that was the whole story, we wouldn't be talking about a potential buy rating, would we?
Right. There must be something else going on.
There is. We have to pivot now and talk about the really positive news and strategic moves that have actually fueled the stock's recent momentum. Because the narrative has shifted pretty dramatically just in the last few weeks.
Okay, this is where it gets interesting then. What's the big news?
The single biggest catalyst was the announcement of a strategic $15 million partnership. And that included taking an equity stake in a company called Satchel, which operates as liquidity.io.
15 million. Okay, so a significant move. What does liquidity.io do?
They're in the regulated digital asset space.
Yeah.
So this deal immediately signaled a more, let's say, aggressive move by Ethzilla into that area.
And how did the market react?
Very positively. Instantly, we saw a powerful 17.38% price jump in just one day.
17% in a day. Wow.
And it continued up another 7.32% over the past week following that announcement. So this is really the definition of a news-driven rally.
Okay, but hang on. If they've had to dilute the stock by over 300% presumably to raise capital, where did they suddenly find $15 million cash for this equity stake?
That's a great question.
Was it cash, or did they pay for it using even more stock?
And that's the thing. Without those 10Q filings, we just don't know the exact mechanism of payment. Was it cash on hand, new debt, more shares? It's a major point of ambiguity.
And that ambiguity is central to the risk here, right?
Absolutely. It's why this is still firmly in the speculative camp. Investors right now seem to be operating on the assumption that this deal is immediately beneficial, strategically necessary for growth, regardless of, the fine print on how it was actually financed.
We also need to keep this recent jump in perspective, though. While the stock has bounced significantly lately, the total shareholder return is still down 58% over the past 12 months. So this isn't a case of a company hitting new highs. It's more like one that's just managed to claw its way back from a really deep hole.
That's a very fair point. And it's likely why management has been so proactive recently. They're clearly trying hard to change the market narrative, improve the stock's image, maybe make it more accessible.
How so? What have they done?
Well, they executed a classic maneuver, a reverse stock split, a 1-for-10 split, which they completed back on October 20th, 2025.
Okay, break that down. A 1-for-10 reverse split. What does that mean for a regular investor holding the shares?
Sure. So a reverse split reduces the total number of shares out there.
Yeah.
If you owned, say, 100 shares trading at $1.80 before the split.
Yeah.
After the 1-for-10 split, you now own just 10 shares, but each share would be priced at $18.
Okay. So the total value of your holding stays the same, but the price per share goes way up.
Exactly. It's often done to make the stock look, I guess, more substantial or prestigious, boost the price. And critically, sometimes it's done to meet the minimum price requirements needed to stay listed on major stock exchanges. Avoid getting delisted.
So kind of a cosmetic fix, but maybe a necessary one for perception and marketability?
You could call it cosmetic, yeah, but strategically it can be important. They also brought in new leadership, appointed a John D. Kristoff as senior vice president.
What's his role?
Seems focused on driving these new initiatives, scaling things up, rather than just, managing what they already had. It signals a focus on growth tied to these new deals.
Interesting. And what about their core strategy? Is there anything unique there?
Well, yeah. What's maybe most unique is their really aggressive accumulation of ETH tokens, Ethereum.
Okay. So they're not just a tech company. They're also heavily involved in crypto directly.
Very much so. They're betting big on Ethereum. This makes them almost like a crypto proxy play in some way.
How big a bet are we talking?
Huge.
Yeah.
They added another 7,600 ETH just in August. Their total holdings now, over 102,200 tokens.
Wow, over 100,000 ETH. That's an enormous treasury position in a digital asset.
It is. And that strategy, it directly links the company's performance and, its perceived value to what happens in the broader digital asset market, especially Ethereum. It positions them for maximum exposure if that sector expands.
And that kind of aggressive crypto holding, that's probably what gets the technical traders excited, right? Because it turns the stock into almost a leveraged bet on the ETH market itself.
Absolutely. Which brings us nicely to the technical picture. So is this recent rally sustainable from a charting perspective?
Yeah, what are the charts saying?
Well, technically, the picture looks strongly bullish in the short term. It confirms the momentum we were just talking about. The current price is around $18.03.
Okay.
We've seen it trading in a channel, sort of bouncing between $15 that seems to be key support and this $18.03 level, which has been resistance for the last 3 months or so.
Right. So the big question technically is, can this recent positive news actually push it through that $18 resistance level?
Exactly. And what are the indicators telling us about the strength behind this recent move?
Yeah.
Well, they're pretty aligned on the bullish side for the short term. The MACD, that's the moving average convergence, divergence, a momentum indicator, it's positive right now and signaling a buy.
Okay, that's one positive signal.
And maybe more importantly, the price is currently trading above all the major moving averages, the 10-day, the 50-day, the 100-day, and the 200-day.
Trading above all those averages, that's usually seen as a pretty powerful technical confirmation, isn't it? Suggests the recent momentum isn't just a temporary blip, maybe more of a structural shift in the short-term trend?
That's generally how technicians read it, yes. We also look at the Relative Strength Index, the RSI. It's sitting around 57.83.
And what does that tell us?
The RSI measures the speed and change of price movements. Generally, an RSI above 50 indicates a bullish trend. So 57 is, heading firmly into bullish territory. But it's not yet overbought, which suggests there might still be room for the stock to run before it's considered overheated, technically speaking.
Okay, so the technicals look supportive in the short term. But all of this positive technical stuff, it feels like it's overshadowed by one really scary statistic investors absolutely have to be aware of.
You're talking about the volatility.
Exactly, the extreme volatility. Our sources flagged it at 113.64% over the last 30 days.
113%, yeah.
Yeah.
It's incredibly high.
Can you put that number in perspective? What does that actually mean for an investor?
It means that in just the last month, the stock has seen massive swings. We're talking frequent double-digit percentage moves, up and down, sometimes daily. It just dramatically amplifies both the potential upside and the potential downside risk.
So this is absolutely not passive investing.
Not even close. This is high beta trading. You're essentially strapping yourself into a vehicle that's designed to magnify whatever the market, or specifically news about this company or crypto, does. It's extremely sensitive to headlines, rumors, any shift in sentiment.
So you're basically riding a roller coaster that seems built entirely on speculation and news flow rather than, say, confirmed operational improvements or earnings growth.
That's a pretty accurate description right now, yes.
Okay, so if the stock is that dependent on news, what are the critical events coming up? What should investors have circled on their calendars?
Right. The near-term event horizon is really Q4 2025. And it's pretty packed. But the single most critical date, the one that's sort of non-negotiable for the whole investment thesis right now, is November 14th, 2025.
November 14th. What happens then?
That's the expected date for their Q3 2025 earnings report.
The earnings report. That feels absolutely crucial here.
It's everything, because it should be the very first chance for the company to maybe provide some clarity on whether that Liquidity.io deal is generating any actual revenue traction, and potentially, just maybe, offer some kind of measurable financial data, even if it's unaudited.
So it's the first real test of whether this whole bullish narrative can actually hold up when it meets, well, reality, or at least some semblance of financial reality.
Precisely. Beyond earnings, there are other sort of market structure things happening, like potential ETF rebalancing expected around November 21st. That can sometimes affect liquidity or institutional interest, depending on how indices change.
Okay.
And of course, the market will just be watching very closely for any signs of early adoption or revenue generation success from that key Liquidity.io partnership. Any positive data points there will be seized upon.
This also feels like a sector where rumors and speculation often run way ahead of any actual data. Is there much chatter around Ethzilla right now?
Oh, the chatter is intense. We've seen frequent rumors floating around various financial forums and social media. Now, these are unsubstantiated, need to stress that.
Okay, but what kind of rumors?
Well, one persistent one, probably tied to their huge ETH holdings, is about potential eligibility for inclusion if, hypothetically, a spot ETH ETF structure gets approved down the line.
Okay. Getting into an ETF would obviously be huge for legitimacy and demand.
Instantly. Then there's the usual M&A chatter, unconfirmed talk of discussions with maybe a major blockchain infrastructure firm, or possibly strategic international expansion, particularly maybe into the Asian market.
Right. And these rumors, even if baseless, they serve a purpose, don't they? They inject speculation, keep that high volatility going, and help sustain price movement when there's no real fundamental data to trade on.
Exactly. They fill the information vacuum, for better or worse.
Okay, so let's try and tie all this together then. What's the final investment thesis look like based on everything we've discussed?
Well, our sources seem to consolidate the overall rating as bullish. But, and this is crucial, it's labeled a 7.5 out of 10, and it comes with that massive, massive caveat. Highly speculative.
7.5 out of 10, bullish but highly speculative. Okay, so that rating, it's based almost entirely on the potential catalysts, right? The partnership, the new management, that big ETH treasury, the technical momentum.
Correct. You are essentially betting on the successful execution of future potential. You're betting on the story playing out positively. You are not betting on verifiable past performance or a solid financial foundation, because those just aren't there right now.
So who is this investment best suited for then?
Given all that, The best fit seems to be for nimble, risk-tolerant traders, people who can actively manage positions and leverage these upcoming defined catalysts in Q4,
Mhm.
especially that November 14th earnings report. There's probably the highest leverage point. You're essentially trading the news flow.
But if you're more of a long-term investor, someone looking for stability, maybe requiring a clear margin of safety based on fundamentals,
Then you almost certainly have to remain on the sidelines for now. You really need confirmed revenue traction. You need some semblance of financial disclosure, some evidence of actual operating leverage before you could justify scaling in meaningfully.
so it's very much a story stock, not a balance sheet stock at this point.
Perfectly put. The massive dilution risk and the complete lack of fundamental transparency require extreme caution. Even while, yes, the big ETH treasury and the recent strategic moves make for a really compelling narrative, it's a high-wire act.
Absolutely. So as you, the listener, consider whether to act on this potential 7.5 rating, you really have to ask yourself, how much weight should you put on that future potential, things like partnerships and management changes, when the current verifiable financial data is basically non-existent? It raises a really important question about how you balance that excitement and narrative against doing the fundamental homework.